This is section 12.4 in your book, and it's on preparing the payroll checks. So we figured out what we need to pay people, and in this section, we're actually going to pay them. So there's two parts of this section. The first part, we're going to talk about the payroll bank account. So what that is the business, in this case Hobby Shack, has a separate checking account that the only thing that goes in and out of there is payroll. So the first part of this is we got to get the payroll money into the payroll checking account. So we write a check for what payroll is, and our payroll is going to be everything that we owe all of our employees. So Franklin Public Schools, everybody that works here, we're going to use the payroll. And remember, what we actually pay them is with all the deductions taken out. So that amount that we figured in the last section, we're going to take that total amount, and Hobby Shack is going to write a check for that total amount, and they're going to deposit that check into their payroll checking account. Now, there's a couple reasons why you want to do this, why businesses would keep a separate payroll checking account. If you're a small business and you have 1 or 2 employees, you're probably not going to do that. But if you're a big business, it helps protect and control the payments that come out of that account. And what it will catch, it really is looking for kind of fraudulent things. Things it'll catch is if somebody tries to alter their check, or if an unauthorized payroll check gets prepared by someone else, someone just decides they're going to write a check on your business for payroll like they work there. The special account is going to catch it because it's going to be not going to have enough funds because you are only depositing enough for that payroll period. So if a check gets altered, or somebody that's not supposed to be taking money writes a fake check, immediately the bank and Hobby Shack are going to know, because if that account becomes overdrawn, something happened, because in theory it could never become overdrawn because you're only putting in as much money as your people are going to be taking out when they deposit their checks, or cash their checks, I should say. So any balance in this account corresponds to the sum of the outstanding checks. So what that means is each of the 4 kids in accounting, let's say I was paying you, you work for Hobby Shack, you each get $25 on your payroll check. Let's say that the 2 juniors have cashed their checks in and got their $25. So now $50 has been taken out of that account. So the $50 that's left in there are from the 2 outstanding checks from the seniors, Emily and Libby. Their checks are outstanding because they have not cashed them yet. So that $50 is the amount that's in the account, and it's also the amount of the payroll checks that are still outstanding. So it's a little check and balance, and it's an easy way to catch fraud. And in a big business, that would be pretty important because it would be harder to catch otherwise. So here is the check that the business is going to write to put in its payroll checking account. Here is the check stub, which you always prepare first. You have the date, the amount, the payroll account it's going into, which is this one, and payroll for, they ask what it's for. It's payroll for December 1st through 15th in this instance. And then down here is your balance that you're carrying forward of your account. Here is where you just write the check, just general check writing rules, nothing fancy there. Okay, so we've put the money in our special payroll checking account. We've written the check and transferred the money. So now we need to write out the checks to our employees, or have them printed, or whatever manner we do it. So all of the information we use to prepare these checks comes from the payroll register that we completed in the last chapter, section of this chapter. Special payroll check form is used, and you'll notice when you look at it down here, it has a detachable stub that records earnings and everything taken out, all of your deductions, and then it gets down to your net pay. And then employees get to keep this part of the stub as their record of deductions and the cash that what the check was actually written for, the amount of the check or the cash they received. So the stubs are really their proof, and it keeps track of what they've had pay into the government for the year and all that kind of thing. And then it shows what their actual net pay was. So here all you do is you prepare the check stub, and then you prepare the person's check. So that's not too bad. Now, there's also something called electronic funds transfer. And if you work for a bigger company, they probably have that. In Franklin, the school uses this, the nursing home uses it, and the hospital uses it. I know for sure. And those are all, I don't know if CPI is another big employer in town, and I'm not sure what they use. But electronic funds transfer is just a computerized cash payment system that transfers the funds, and it doesn't use checks, currency, or a paper document. And some businesses, like I said, the ones in Franklin that do it, deposit their paychecks in this way. So, like, I get my paycheck, the only thing I see is this part down here. I get a stub. And that stub is like the stub on a check, but it's my statement of earnings and deductions. The bank then, once the bank gets that electronic funds transfer that we send in, like for instance, the school sends in for each of its employees, then it takes that amount and adds it to each employee's bank account and takes it away from the payroll account of the business. So payroll is still calculated using the electronic funds transfer, but the difference is they don't hand out paychecks, they don't write paychecks. It automatically goes to your bank and you just get a stub. So that is what the last section of this chapter is over. So you should be good to go. If you have any questions, as usual, be sure to ask me.